U.S. consumer spending in March had its highest increase in nearly a decade, surging 0.9%. The jump up from February was due in part to the rise of purchases in sectors like auto and healthcare. But what does this signal for the retail industry at large? Joining us is Cornell Capital partner Ann Berry. She's here with me at the desk today, and it's good to have you on today. So let's start with that economic data. What do you think that points to in terms of the strength in the retail sector right now?
Well, I think you're seeing these amazing tailwinds really powering consumer confidence with, low interest rates, which means consumer credit can be strong. You're seeing people make big ticket purchases. I think that's what's driving things like auto. Low inflation, meaning prices aren't ticking up. So at a macro level, you think that the retail sector is really poised to power on through growth. But I think you're seeing the shuffling out of winners and losers still, particularly in the light of the Amazons of the world coming out with new innovations like one-day shipping.
Yeah, pointing to that, we are looking at store closures, 4,000 stores being closed in Q1 alone. Is that just a shakedown that we're still seeing, as you pointed to? And if so, what are the big losers on the other end?
Yeah, I think peeling it back is exactly the right question. Of that 4,000, about 2,500 are Payless alone. That's one of the biggest retail liquidations in history. And then you've got other formats like Sears that have suffered, Gymboree which have suffered. So I think when you look at the big box specialty, when you look at the department stores, they're really trying to still struggling to figure out their identity. On the other side, some specialty retail, Lululemon had a great end of year last year. Some of those who are really innovating and really thinking about new ways to connect with the consumer are coming out on top in light of the strong environment.
Every retail conversation we have, we talk about the Amazon effect. And the recent quarterly numbers were strong for Amazon. And yet a lot of analysts pointing to that saying things are starting to slow just a bit. You're not seeing the kind of growth that we've seen from Amazon in previous years. Is that a symptom of the retail sector? Is it about the competition that's eating away at Amazon's market share? How do you assess the numbers?
I think it's a little bit of both. I think some of the other big behemoths who've been watching are starting to get their act together. I mean, Walmart's digital revenue was up 40% last year, and you've got others like Kohl's trying to figure out how to partner with Amazon or figuring out an omnichannel approach to help really sort of stave off the competitive threat that Amazon presents.
And that one-day shipping for Prime members, how big of a game changer is that likely to be for Amazon?
Well, it's going to be expensive to start with. It's going to be about an $800 million investment, I think, is what they came out and said. But if you think about the stickiness that creates for the Prime customer, the degree of convenience that that's going to offer, I think it's going to be pretty unmatchable, at least in the short run.
You talked about some of the names that have been doing well in this transition or the omni-channel approach, particularly Walmart. How do they match a strategy like that coming from Amazon? I mean, they've got a different strategy in that you can do grocery pickups at the brick and mortar stores because they already have that footprint in place. Is the idea here for Walmart to continue with that kind of strategy, or do they have to one-up Amazon on the delivery side?
That's a great question. I think the likes of Walmart has to play with the hand that they're dealt. So I think the strength of Walmart is that huge store footprint. And in a way, they're able to get to that one-day shipping equivalent by allowing the customers to go pick up and drop off using that store footprint today. But I think there are others. I think you're seeing the rise of sort of more boutique-y e-commerce subscription models. That's the kind of thing that's made Stitch Fix so successful. And I think as you're going to see a separation, the big behemoths, the Walmarts of the world, and then the boutique niche players who are able to sort of really target consumers in very specific ways.
More the custom tailored approach there, if you're talking about names like Stitch Fix. What's the big name you think we're overlooking in retail?
I think something like a Target really could be one that is worth watching some more. I think Target's being very thoughtful about what kind of product selection they're going after. I think they're in the early innings of figuring out their omni-channel, the marriage of their online and their store footprint. So I think you could see them tearing up if they really get their strategy right.
When you say omni-channel, I mean, we talked about Walmart and their approach. What's the omni-channel approach for Target that separates them from some of the competitors?
I think it's somewhat similar, but I think they've got a particularly attractive urban density model. Their end consumer, I think, is a slightly more tech-savvy demographic. So I think in terms of their existing customer base, it particularly lends itself to having this approach with success.
So if we look at kind of rounding out the conversation, we started by talking about the economic numbers or the retail numbers that we've gotten recently. Have we seen the bottom? I know it's always tough to call that there, but there was so much concern, around December, and yet we've seen the numbers slowly prop back up. Questions about whether these numbers that were that pointed to the headwinds were just seasonal seasonal, whether it was a broader trend. What are you seeing if you start to connect the dots over the last few months?
Well, I think a couple of things. GDP growth was stronger than anyone expected coming out of Q1, north of 3%. And I think the other key piece of this here is the Fed, they're coming out on Wednesday with their recent thoughts. But the fact that the Fed has said we may not have a rate increase this year versus the 4 that we saw last year, that they are willing to watch the market very closely to try to be more reactive than prescripted. I think that's given a whole renewed sense of confidence that this sort of Goldilocks economy in the US may well continue for a while.
Okay, so it's a positive note that we'll end on there. And Barry, they're joining us from Cornell Capital.